Good morning, this is Rob McDougall from Zhang Financial with your weekly economic update. Today is Monday, May 22nd. So last week, in terms of economic data points that we received, it's a pretty slow week. We had two sets of data points last week. One that showed us the health of the U.S. consumer, and the other were two housing-related metrics. And it confirms what we've been seeing in general over some time here, that the U.S. economy is actually stronger than expected, and the only area that's really been negatively impacted by the aggressive Fed rate hikes over the last year has been the housing sector. So, for instance, last week we had retail sales for April and retail sales ex-auto. Retail sales in general came in above expectations at a very strong 0.7% month over month, and the consensus expectation was a 0.4%. So that was really strong. Retail sales ex-auto, so autos were strong last month of April. So retail sales ex-auto was just a little bit weaker than expected, came in at 0.3 versus consensus at 0.4. But total retail sales, strong. The reports on the housing sector, we had housing starts and we had building permits, and just like we've seen for most of these metrics over the last year, the data points were below expectations and they were considerably down on a year-over-year basis. So housing starts for month of April came in at 1,405,000 or 401. They were expected to come in at 1,405,000. Building permits were expected to come in around 1,438,000. Came in at 1,416,000. So continued pattern of what we've seen. Most economic data coming in as expected or better. Housing, not so much. So let's talk about the Federal Reserve and GDP expectations. We touch on this most weeks. With the stronger than expected April data that we've seen, the Atlanta Federal Reserve puts out a report every week. We follow it every week of their expectation for GDP growth in any given quarter. And usually it looks pretty high, but they have been coming in very close to where the actual number comes in, ex inventory corrections. They actually took their expectation for Q2 2023, the quarter end currently, they took it up again last week. So they took it up to 2.9%. It was at 2.7 last week. So the economy stronger than expected. Now there's a dichotomy here. The Federal Reserve clearly is reacting to what they see as strong data points. So they're unwilling to say they're at the end of the tightening cycle, and they're definitely not discussing, or they're actively telling people not to expect decreases in the Fed funds rate. But that's not what investors are expecting. When we take a look at the Fed fund rate futures, particularly at the end of the year, certainly paints a much different picture than one that we're hearing from the Federal Reserve. So the next Fed meeting, FOMC meeting, is June 14th. And on that, the expectation for them to actually increase 25 basis points, another 25 basis point increase, those odds have been going up the last 3 weeks. Last week, the odds of a 25 basis point increase was 21%. As of Friday, it was 23.3%. So certainly some movement there. Investors starting to brace themselves for a potential increase next month. Then the real change is when you take a look at the end of the year in the expectations. So just a couple of weeks ago, there was zero expectation that interest rates would stay as high as they are right now. The Fed funds target rate, 5 to 5.25. So that has been changing. And so it still tells a story or suggests that the Federal Reserve will be cutting interest rates by the end of the year, but not quite as aggressively as we've seen in the last few weeks. So right now, the odds of a 75 basis point decrease from where we're at right now, the 500 to 525, that expectation fell from a 42% probability the week before to 14% at the end of last week. So that's getting pushed out in terms of the Fed cuts. And again, this is all a response because of the strong economic data that we've seen, the Federal Reserve Bank of Atlanta is seeing. So expectations for future rate cuts definitely going down. Inflation expectations, we always look at the 10-year chart, the 10-year break even. That rose a little bit last week, hardly worth mentioning. It was up 6 basis points to 2.24%. Again, the interpretation there, investors betting inflation will average only 2.24% for the next 10 years. Another topic I should bring up again today, we talked about last week, and that's the U.S. debt ceiling crisis and where we're at with that. So update is last week there were at least 2 meetings between House Leader Kevin McCarthy and the White House, Joe Biden, and there's the expectation of another meeting either today, Monday, or possibly tomorrow, Tuesday, to come to some sort of agreement to lift the debt ceiling, which is currently at $31.4 trillion, up, because if that is not raised sometime in the near future, probably mid-June, per Treasury Secretary Janet Yellen, the U.S. government is not going to be able to meet all their obligations and possibly on not paying U.S. debt. So we talked about this last week, and the fact that this has happened, these debt ceiling negotiations have happened 78 times since 1960. We've actually had government shutdown at least a half a dozen times during that. So it's not that it doesn't happen. It does happen. It's disruptive, not to minimize it. But what we've seen in the past has been short-term pain, and then it kind of goes away. So we're not getting too worked up or concerned about it. And just want to, again, point out that 2011, something like this occurred, did in 2013 as well. But the 2011 one was pretty severe. It was the first one of real significance in many years. So what happened was it was a Tea Party, and they were wrangling over spending. The Republicans dug their heels in. So they debt ceiling negotiations as they started, and they got into it, and they came to an impasse. The S&P 500 fell pretty significantly. From top to bottom, it was down 17%. So that was in June of 2011, and that dragged out for a couple of months. They finished off negotiations, raised the debt ceiling. At that point, the debt ceiling that they were raising was $2.1 trillion. Again, today we're at 31.4. So a little increase in the last 13 years. But I showed last week what happened for both the S&P 500 and the U.S. government bond index during the crisis in 2011. And the takeaway there was, yes, the S&P got hit actually for a couple of months and then came back very strongly. So this all started in June 2011. In October 2011, S&P was up over 10%, finished the year up 2%. But the big winner during all of that, U.S. government debt. From the beginning of the crisis, June 2011, through the end of the year, U.S. government debt index was up over 9%. So let's segue here to the market reaction, how the markets did last week in terms of equity, international equity, and fixed income. So you might expect poorly, but it actually did very well. The S&P 500 last week up 1.7%. The S&P 500 is now up almost 10% for the year, 9.9% as of the end of the day Friday. The strength last week, again, this has been a theme this year, mega cap growth. That particular ETF, Vanguard's ETF, mega cap growth up 2.9%. So while S&P 500 up strong last week, again, it was up 1.7%. International equities on the week, pretty much flat. The MSCI All-World ex-US Index was up only 20 basis points against the S&P, up 1.7. So fixed income, clearly money rotated back to risk, back to the stock market. So treasuries were actually hit pretty hard last week. The U.S. 2-year Treasury, the yield rose 29 basis points up to 4.27. The 10-year yield rose 23 basis points to 3.69. So for the week, the U.S. Bloomberg U.S. Aggregate Bond Index was down 1.4%, dropping the year-to-date gain now on that index to still a positive, but a positive 1.9%. So this week, economic activity. Now, I mentioned, obviously, the debt ceiling negotiations. That's going to be huge this week. We'll see what happens with that. Otherwise, it is a pretty light economic calendar, at least until Friday. So today we get the April new home sales. That's expected to come in at 660,000. It was 683 in March, so we're expecting down a little bit there. On Friday, though, we do have some important releases, particularly inflation. So the PCE, the Personal Consumption Expenditure Index, again, that's the one that the Federal Reserve uses for policy setting. That is expected to rise. Both the PCE and PCE core are expected to rise 0.3% month over month. So if the PCE itself does come in at that 0.3%, the annualized rate would drop to 4.1%. So this index, as the CPI index, peaked last June. The PCE peaked at 7%. In March, it had fallen down to 4.2%. And again, if it comes in at a 0.3% month-over-month increase, that will drop it down to a year-over-year rate of inflation of 4.1. Now, clearly not down to the Federal Reserve's goal of 2.0, but again, we continue to make monthly progress towards that. I think it's great. Also on Friday, we get personal income and personal spending, see how the consumer's doing. Both of the indexes are expected to increase 0.4% month over month, and both of those indicators would be increases over what we saw in the month of March. So that's it for the economic recap for this week. Thank you very much for attending. We'll look forward to seeing you next week. Thank you.